Hey everyone and welcome. We hope this video message finds you well. I'm Justin Dean, and I'll be joined soon by Matthew Witt and our Chief Investment Officer, Tony Parrish. We're going to go over our annual State of the Markets presentation and go over some of the questions that we've heard from you. Stay tuned and enjoy. So one of the first things we wanted to jump in and talk about today, similar to our State of the Markets from last year, Tony, is the geopolitical landscape that we're in.
Yeah, I mean, everybody's concerned about the Iran. I had never heard of the Strait of Hormuz. Now you hear about it all the time. So, and it feels like we've obviously had conflicts in the past, but Iran does feel different. I don't know if it's just recency bias. I mean, maybe they all feel different, but Iran did feel really, really significant, and it did have a lot of clients concerned. And the markets obviously were a little concerned too. There was a pretty big drawdown. Maybe back on track now.
Yeah, so we're recording this on the 17th of April. By the time people actually, see this video, the situation may have changed again. It's that fluid, right? So for the last 2 years, we've had a big roller coaster ride in the stock market. Back in 2025, it was the Liberation Day tariff announcement. Stocks plummeted, dropped over 20%, and then bounced all the way back and then hit new all-time highs. And then with the skirmishes in the Middle East, stocks plummeted again earlier this year, and as of today have gone back to resume their upward trend and are now at new all-time highs. In terms of trying to predict the next geopolitical event or the next announcement in the Middle East or elsewhere, I think it's really important for investors to take a step back and realize that we are in a period of very charged markets where stocks can plummet or stocks can skyrocket. And it's important to not try and time these events or predict these events. I think it's impossible to time and predict them unless you have some kind of insider information, which most of us don't. So it's important to make sure that we have a financial plan that's in place, knowing that there's going to be times of extreme volatility, but over the long term, markets tend to rise. And we have to have a plan that will allow us to participate in those market up movements over time, yet also not force us to freak out and sell and change our plan when we have periods of drawdown like we had in the first quarter this year or the second quarter last year. So to me, that's the big takeaway. I honestly don't know what's going to happen with the Middle East. And things may happen between the time we record it and the time people see it. The point is people have to feel comfortable staying invested regardless of what geopolitical events pop up.
Do you feel like the markets are more headline driven, more so than like fundamental driven? Because I don't have a ton of experience, but it just seems like you're caring more about what the news says that particular day than maybe an earnings report.
No, it hasn't always been. There was a time when, for most of the history of the U.S. stock market, like the last 100+ years, where stocks would generally move based on things like earnings and new product launches and new management and expectations of consumer demand for those products and things really having to do with balance sheets and income statements and cash flows and fundamentals. It seems like a quaint time now, and certainly a lot of the stock market still does trade based on fundamentals. However, there are bigger name companies out there, some of the mega cap companies like the Nvidias and the Teslas and the Alphabets and Amazons and Apples of the world that are very, very much driven by headlines. And so those companies can continue to, in some cases, they have very good earnings, and when they announce good earnings, their stocks go up. Which gives us the impression that they are trading based on some measure of, a connection to fundamentals. But other times they can come out and completely disappoint the markets, and their stock will go up, or they can give an announcement that's generally rosy and beat expectations, and their stock goes down. And so a lot of what we're seeing right now in the last certainly 5 years in the era of meme stocks, et cetera, is that there's way more activity of stock movement that's driven by headlines, on tweets, on perception, et cetera. Case in point, again, it's the 17th of April. Just this week, the shoe company Allbird basically said they're no longer going to make shoes. They're going to sell off the licensing of their shoe business to a third-party entity, and they're basically going to be an AI company now. They're going to, build out AI infrastructure, and they're going to basically rent computational bandwidth to companies that need it, right? And their stock rallied 900% on Wednesday. And then yesterday, Thursday, the stock crashed 600%. When investors started saying, well, wait a minute, $50 million that you're getting from the shoe business is not that's like 5 seconds of AI computational cost, right? Like the numbers just don't add up. Now they're still way up relative to where they were before the announcement came out. But the point is there's a lot of money that is just chasing headlines and chasing tweets and chasing ideas that are just not grounded in fundamentals. Over the long term, fundamentals will drive the company, but over the short term, headlines seem to be driving the company.
Speaking to this new AI world that we seem to be in or living in and adjusting to from the individual perspective, you hear a lot of talk about the AI bubble. And so, are we in an AI bubble?
Well, that's always the comparison you hear, like the euphoria around the .com era. But to your point, it does kind of feel bubble-ish if a shoe company can just mention that they're pivoting to AI and their stocks shoot up. But on the other hand, there's like Nvidia is clearly making money. I mean, when they do their earnings reports, the revenue's wild. So is it reminiscent of the .com bubble, or is this completely different? Because there are some big names that are clearly making money.
NVIDIA is clearly making money. You're absolutely right. That's like the analogy I would make is they're the company that's selling shovels during a gold rush, right? They're selling the chips that are helping with this AI, euphoria that's going on. And there are some companies that are finding ways to make money from AI. For instance, Microsoft has their Copilot, application, which is driven by AI, and it's embedded into the Microsoft Office suite. There are companies that are making money from AI by being able to better define their clients and do data research on clients, so maybe their sales activities are more effective. But the money that those companies are making, the money that's being made from those activities are not nearly as large, by order of magnitude smaller than the amount of money that is needed to really build out an AI future that is going to materialize these aspirations, right? So a lot of what we're seeing right now is actually reminiscent of bubble territory. In fact, we went back and we looked at historic bubbles. We went back to the bubble that led up to the 1930s crash, and leading up to the 1986 crash and the dot-com crash and the global financial crisis. And we looked at the characteristics of those bubbles to try and determine, are we in a similar kind of environment today? And we identified 7 different categories that categorized all of those bubbles, and every single one of them is in effect today. Stock prices are at all-time highs. There's easy borrowing and high speculation. There are incredibly high valuations, especially for new technology or new ideas. There's fear of missing out, FOMO, and herd behavior. There's regulatory complacency. There's sector-specific mini bubbles that are popping up. And there's a tremendous proliferation of alternative assets in the financial services industry. All these things are present today, which suggests that we are in somewhat of an AI bubble, just like we were in a dot-com bubble back in the late 90s. Here's the important thing, though. When Alan Greenspan the former head of the Fed, came out and coined the term irrational exuberance to talk about what was then an AI bubble, he coined that term 3.5 years before the bubble actually burst, right? There was a tremendous amount of money that was made, and the stock market went up tremendous amounts between the time he identified bubble-like euphoria on the one hand versus an actual correction on the other hand. And I get the sense that the same is true today, that we still have some more for this bubble to inflate. And when it finally does pop, there's going to be a lot of indiscriminate selling that goes on, but there are going to be some companies that are still standing, like the Amazons and the Apple companies were, in the dot-com era, and they're some of the biggest companies today. So there are bubble-like characteristics, but investors would do well to understand history and make sure that we are investing in such a way, knowing that a lot of the hot money that's chasing companies right now, because they are putting the term AI in their company name, a lot of those companies are not going to be worth as much in the future as they are today.
The amount of energy demand that it requires, I think a lot of us weren't aware of the amount of energy that it required. And why are nuclear and power infrastructure is that why they're getting so much attention right now?
Yeah, I think so. We talked about how the markets haven't really fully digested the effects of inflation and higher Fed interest rates on the price of the market. We also talked about how there's a disconnect between fundamentals and kind of headlines, right? I think another area where there's a disconnect in the market is the euphoria around AI and the amount of energy it's going to take to drive all these AI, superscalers. We really have an old, creaky energy infrastructure in the U.S. We really do. That's why, you've got companies like Microsoft that are looking at, buying old nuclear facilities that were decommissioned and then getting them back up and running, or, investing in new nuclear facilities to generate more energy. I think that the energy need and the water need, by the way, it's not just energy, it's also water, to run the kind of computational, industrial scale computational activity that's required for AI generation on a large scale. Those two things haven't really been identified in terms of where the energy and where the water is going to come from. So once again, it's an example of how the markets are trading on euphoria. But then when we start doing a back of the envelope calculation about what it's going to take to realize some of these AI dreams and aspirations, we realize, it's not quite as easy as we thought. So we're undoubtedly, look, the common theme here is the markets are supercharged with tremendous euphoria around AI and the skirmishes in the Middle East coming to an end, but also tremendous revelations that are possible around new developments that will cause people to radically reassess valuations. Investors should assume we are in a higher volatility environment throughout 2026 and make sure that we have a plan in place, knowing that it's the right plan for us, and have the discipline to stay invested and ride through the volatility. That's the important takeaway. We're in charged markets. We're going to see big pops up and big drops down. Let's make sure we have the right plan in place and stay with the plan.
And so what does that mean for the average retiree? What would you say to them?
I think for the average retiree, don't fall into those emotional traps of fear and greed and short-termism, right? That's really what it's all about. When the markets go up, we get greedy and we buy, and then the markets go down and we get fearful and we sell. But guys, that is the exact opposite of what we should be doing. Markets go up and we buy, we're buying high. Markets go down and we sell, we're selling low. We shouldn't be buying high and selling low. We should be buying low and selling high, right? So it's important for us to stay out of those emotional traps and work with you, Justin and Matt, to make sure that every client has a financial plan that makes sense for them, for their specific needs, and will get them to their destination, knowing that there's going to be volatility and rocky periods in the market, and they have to have some faith and some confidence that the plan is right for them, and have some discipline to avoid those emotional traps. Specifically, as it relates to the AI bubble or AI euphoria, I would avoid buying individual companies, because we just don't know. We're going to have IPOs coming out, OpenAI and Anthropic and SpaceX, for instance. These are big companies that are going to come out with giant valuations. Instead of trying to hop on the greed train and not really knowing how those prices are related to fundamentals, you can get exposure to those companies by buying well-diversified indices like the S&P 500 or the NASDAQ, for instance. So it's important to stay diversified, important to stick with the plan, and avoid following those emotional traps such as fear and greed and short-termism.
We've also got inflation that we're still combating and still dealing with, which I think has, caused people to pause and think about, how much money do I need to retire? And everything keeps getting more and more expensive. And so how has inflation, from your purview, changed the average person's perspective on that?
Yeah, prior to 5 years ago, I think a whole generation of investors had come along without really knowing what inflation was. I mean, prior to 2021, 2, and 3, inflation really was a term from the 1980s, or going back much further, to the 1930s or whatever the case was. And suddenly in 2021, 22, and 23, we really got a reminder of what inflation is like. Inflation has come down quite a bit since then, but prices have not come down, right? That's the important thing. Economists measure inflation in terms of percentages. Real people measure inflation in terms of dollars. And the dollar the amount of dollars it costs to pay for your basket of groceries or your tank of gas, it has not come down and will not come down. That's just not how inflation works. Now, those prices may not be rising as much, in 2026 as they were in 2022, but they're still rising, right? So it's important for investors to understand that sitting in cash is a losing strategy because cash itself has its spending power eroded every day as inflation continues to march on, which inflation does. One of the best ways to defend against inflation is to invest in assets that appreciate in value at a higher rate than the inflation rate, right? So investing in stocks is a great way to hedge an inflation bet, and investing just in cash, especially hard cash, cash that doesn't earn any income, that is going to be slowly eroded by the ravages of inflation. Comes back to having that well-identified plan, sticking to that plan, and making sure you have exposure to assets that are going to beat inflation, even if inflation stays reasonably high.
Well, and some of our favorite tools that we utilize are some of the models that proprietary models that you've developed: RetireLink 1, RetireLink 2, and RetireLink 3. And so RetireLink 1, the goal of that is to keep pace or beat inflation.
Yep.
RetireLink 2 is a little more moderate. It's money that our clients will need in 6 to 10 years.
Right.
And then we have RetireLink 3 that we utilize for monies that we'll need in 10 plus years. And we also utilize some of the Twin 50 model that our clients are well aware of.
Yeah.
When we look at some of that and putting that in, that absolutely, especially RetireLink 1, is a great hedge against inflation in our experience, and has done exactly what you designed it to do. And so we're so grateful for that and love that. And so when we look at this, the markets, is there cause to have a little bit more diversity internationally versus just domestically?
Yeah, this is a great question. If we look back over the last 10 years, even a little more than 10 years, the U.S. market has beat most all other developed markets, right? You want it to be in the U.S. market because that's where the biggest, most explosive performance has been. IT, for instance, IT is about a third of the S&P 500 now. It's much larger now than it used to be, and that's because we've got these big, the FANG stocks, for instance, that really shot up in value. If you take out those FANG stocks, the performance of the S&P 500 has not been nearly as great. But there's two problems now in 2026 for investors who are looking at the U.S. stock market relative to the international markets. One is that U.S. stocks are expensive. There's two issues with investors looking at the U.S. market in 2026. One is that U.S. stocks are very expensive. They've had this tremendous run up over the last decade. And can you get great performance? Potentially better performance on a per dollar invested than the international developed markets? I don't know. But the more they go up, the more expensive they get. So that's the first problem. The second problem is with respect to diversification. If you're only invested in the U.S. market, it's like swinging for the fences, right? You can hit a grand slam or you can strike out gloriously. 2025 was a good example of the global market, the non-U.S. market, beating the U.S. market. And now we've seen a reversal of that in the first quarter of this year. But basically, it comes down to the idea that the more expensive something is, the more it has to return in order to be profitable relative to things that are less expensive. So I think it's important for investors to maintain geographical diversification and not have all of our eggs tied up in the U.S. basket.
Tony, is this the dumbest example you've ever heard of? Like, I've been telling people, like, my favorite candy bar is Snickers, and I like Snickers for $1. But if all of a sudden Snickers becomes $5, I might start looking at Twix. Is that is that a terrible example?
I think it's a great example. It comes down to what people are willing to pay. And $1 for a Snickers bar, fine. $1.25 may be fine. $2, $5, $10. Eventually, you get to a price. A rational Snickers eater gets to a price where they're saying, I don't care, I love it, but I'm not going to pay that much for the Snickers bar. That's just human psychology, and that's behavioral finance, right? I think that at the end of the day, that's a truism. The idea that you like something at price X, but there gets to be a higher price where you no longer like it. And the opposite is also true. You may not like something at price X, but if it drops to a lower value, Now it's starting to look attractive. Look at iPhones versus Android phones, right? Now, things have changed in the last couple of years, but historically, like 10 years ago, 5 years ago, an iPhone was a premium device, and you paid a premium price for that device. There's a substantial segment of the phone buying population that said, I'm going to have to pay X for an iPhone, or I can buy an Android phone that's 60% of the price, but has 95% of the functionality. I'm going to go with the Android, right? It's just human psychology. So I think the Snickers bar example actually is a great example. I'm going to have to pay X for an iPhone, or I can buy an Android phone that's 60% of the price, but has 95% of the functionality. I'm going to go with the Android, right? It's just human psychology. So I think the Snickers bar example actually is a great example.
You know, one of the things about 2026 people were looking forward to potentially was some Fed rate cuts.
Mm-hmm.
With oil, I think as we're speaking, it's less than $100 a barrel now, but that was the concern. If oil's $100 a barrel, inflation is going to be high. The Fed won't be able to cut the rates.
Funds futures market very closely. And when we came into the month of February, the markets have been pricing in 2 Fed cuts later this year, 2 interest rate cuts from the Fed later this year. And then in the month of February, sorry, in the month of March, it went down to 0, and it's still currently at 0. Like the market is expecting no rate cuts this year. Now, this is really interesting because if you go from an environment where the market expects the Fed to cut rates twice to a market where to an environment where the market does not expect any rate cuts, that is unambiguously bearish for the market. And yet, here we are today on the 17th of April, and the market is at an all-time high, right? So I think there's a disconnect in what's going on in short term. In short term, I think there's a lot of euphoria and relief. It's like a relief rally that we've seen over the last 3 weeks. There's a lot of relief that, you know, we may be seeing light at the end of the tunnel in terms of the skirmishes in the Middle East. But the inflationary picture hasn't yet played out. I'm no oil expert, but my understanding is having stopped the, having shut down the strait and prevented the exit of oil tankers, that meant that the production facilities, the oil withdrawal processes also had to be shut down. And you can't just turn those things on right away. It takes months. There was also a lot of infrastructure that was destroyed in the skirmishes. That will take months or years. Not only oil, but fertilizer was backed up. And there have been other critical items that travel through that strait that have been backed up. Now, the impact of the closing of the strait has not been fully priced in to the markets, right? So I think that we are, even though we're experiencing some short-term euphoria in the stock market, I think when the dust settles in the coming weeks, markets are going to begin to reassess and realize, with the Fed no longer expected to cut rates, as was the case earlier this year, and with some additional inflation that has not yet been felt by pocketbooks of average consumers yet, I think there will be some weakness in the stock market that has yet to play out.
And so it sounds like, we're really kind of up in the air on, is inflation really under control, or we still have some of maybe we haven't felt yet, and we may possibly be in a higher for longer interest rate environment, as you alluded to, than what we had originally planned on this year.
The inflation picture, it's important for us to kind of identify what we mean by inflation. Inflation is really just the price of goods and services, right? And if the price of goods and services goes up, that's inflationary. If it goes down, it's disinflationary. I think that we still have some effects from the tariffs that went into effect in 2025 that are making their way into the pricing now. I think we have some effects from oil that will be making its way into the pricing in the coming months. I think in terms of the fertilizer shortages, if there are, we're probably not going to know about how that affects pricing until harvest time in the summertime. So the important thing is inflation doesn't move like a stock price. It doesn't move like the price of NVIDIA when they announce earnings, where it shoots to the moon or drops drastically. Inflation has an immediate effect, and then it's an input to production, which then has a secondary effect, which then has an input to production or to consumption, which has a third level effect. So I think we are going to see firmer inflation throughout 2026 than most of us had thought coming into this year. due to this combination, this layering effect of tariffs, global uncertainty, skirmish in the Middle East, etc.
The amount needed for a couple of retirement has jumped from like 1.2 million to 1.46 million, almost a $200,000 jump in the last year. And so with all that uncertainty, to your point, I think it's so important. That's why we built out the fiscal house that we built for our clients, that we have monies in the RetireLink series. We've got money for the next, 2 to 5 years. We've got money for 6 to 10 years. And then we've got money that we're needing 10 plus years working hard for us. So that money's going to ebb and flow. RetireLink 3 in particular, more with the market. That's okay because we're not touching that. And it's strategically invested to have 10 years from now, so you can combat the inflation that we are truly facing right now.
Absolutely. And let's not forget the idea of outliving our money, right? People are getting healthier. We talk about AI and all the amazing, activities in AI. AI is helping us to discover new breakthroughs in medicine and preventative care and, nanobiology and all kinds of like really cutting edge stuff that was sci-fi 10 years ago. So we're going to continue to live longer, God willing. And that means we need to make sure that we've got the right investment plan in place to make sure that we don't outlive our savings. So we absolutely need to make sure that we have a good handle on what's available in the market, what are the risks in the market, and put in place good plans to make sure that we're on it. We've got a plan, and that plan can see us through the future, regardless of whether retirees living 10 years, 20 years, 30 years, or 50 years.
Well, Tony, as always, we greatly appreciate your time. And thank you so much for being on here.
We really appreciate your time so much, Tony. Thank you.